Something absolutely catastrophic happened in the financial markets yesterday that most people completely missed while they were going about their normal Friday routines. We're talking about one of the most violent market collapses in modern history, and if you have any money invested in precious metals, retirement accounts, or even just want to understand where the economy is heading, you need to hear this right now. Before we dive into the details of what just happened, I want you to do me a favor. If you're serious about protecting your wealth and understanding these market movements that can make or break your retirement, hit that subscribe button right now for Element Access. We break down complex financial events into clear, actionable information that you can actually use. Drop a comment below too, even if it's just a quick hello, because engagement helps us reach more people who need this critical information. So here's what happened. Yesterday, Friday, January 30th, 2026, silver experienced its worst single-day crash in over 13 years. We're not talking about a modest correction here. This was a complete and total meltdown. Silver plummeted from record highs above $121 per ounce all the way down to $74 in some trading sessions. That's a staggering 35% drop in a matter of hours. To put that in perspective, if you had $100,000 invested in silver at the peak, you woke up Friday evening with only $65,000 left. Gold didn't escape the carnage either. The yellow metal crashed 12%. Falling from its all-time high of $5,600 per ounce, down below $5,000. This represents the worst single-day decline for gold since the early 1980s. We're talking about a level of volatility that seasoned traders with decades of experience have rarely witnessed in their entire careers. Now, let me take you back 24 hours to understand how we got here. On Thursday morning, January 29th, silver touched $121.64 per ounce. This wasn't just a new high for the year. This was the highest nominal price for silver in recorded human history. The previous record was $49.45 back in January of 1980 during the infamous Hunt Brothers Silver Mania. Silver had just obliterated that 40-year-old record by 146%. Think about that for a moment. It took 40 years to break that record, but it only took about 1 month to go from $72 at the start of January to $121. According to the data, silver gained 68% in just 29 days. That's the strongest monthly gain since December of 1979, which was the month right before the Hunt Brothers scheme collapsed and silver crashed 80%. This wasn't just January madness either. Silver had been on an absolutely incredible run for 9 consecutive months. 9 straight months of gains, marking the longest winning streak in years. The metal surged 150% throughout 2025 alone. These were bubble-level returns, the kind of gains that don't happen in rational, functioning markets. By Thursday morning, retail investors were piling in, fear of missing out was rampant, and traders on social media and financial terminals were calling for silver to hit $150, $200, even $300 by year's end. The euphoria was real. Everyone thought they were going to get rich. And then Friday morning arrived, and everything changed in an instant. Early Friday morning Eastern Time, news broke about a new Federal Reserve chair nomination. Now, if you're not deeply embedded in financial markets, you might wonder why a Fed chair nomination would trigger such a violent reaction. Let me explain why this matters so much. Warsh is a former Federal Reserve governor who served from 2006 to 2011. During his tenure, he built a reputation as what's called an inflation hawk. This means he believes in defending the value of the dollar and maintaining price stability, even if it means keeping interest rates higher and potentially slowing economic growth. He's the opposite of what precious metals investors had been betting on. You see, for the last year, the entire rally in silver and gold was built on one fundamental assumption. Investors believed that Trump would appoint someone dovish to run the Fed, someone who would aggressively cut interest rates, print money, and essentially weaken the dollar to support economic growth. When the dollar weakens, precious metals prices go up because it takes more dollars to buy the same ounce of silver or gold. Simple mathematics. But Kevin Warsh represents something completely different. According to his track record during the 2008 financial crisis, Warsh was one of the most hawkish voices on the Federal Open Market Committee. He argued against quantitative easing and warned about the dangers of loose monetary policy. He defended the dollar's value as a strategic national interest. So when markets saw his nomination, they didn't focus on what he's saying now about supporting lower rates. They looked at what he did back then, and they panicked. Because if the next Fed chair is actually going to defend the dollar, if he's going to resist pressure to debase the currency, then precious metals are suddenly massively overvalued. And that's when the selling began. Now, a Fed chair announcement alone doesn't fully explain a 35% crash. To understand that level of destruction, you need to understand what traders call a cascade. It's a self-reinforcing death spiral that turns a 5% correction into a catastrophic meltdown. Here's how it unfolded. Friday morning, silver opened in Asian trading around $119 per ounce. The Warsh news hit. and silver immediately dropped 2%, then 3%, then 5%. And that's when the margin calls started flooding in. If you're trading silver futures, you're required to maintain a certain amount of cash in your account as collateral. This is called maintenance margin. When the price drops too much and your position loses value, the exchange demands more cash immediately. That's a margin call. And if you can't meet it within minutes, they liquidate your position. They force you to sell whether you want to or not. So as silver dropped from 121 to 115, the first wave of margin calls hit retail traders and small speculators who were over-leveraged. Their positions got automatically closed by the exchange. That forced selling pushed the price down further to 110. That triggered the next wave of margin calls on bigger accounts with more leverage, more forced selling. And then something even worse happened. The liquidity completely disappeared from the market. When volatility spikes like this, when prices are moving 10, 15, 30% in hours, the market makers pull their quotes. They stop providing buy and sell prices. They widen their spreads. They reduce their size. Making markets in extreme volatility is incredibly dangerous because you can get caught on the wrong side and lose millions in seconds. So you had massive forced selling from margin calls hitting a market with almost no buyers. And that's when the price started gapping down violently, from 110 to 105, from 105 to 100, from 100 down to 95, 85, and eventually $74 in some sessions. The bids just disappeared. The market was in absolute freefall. Traders on the floor were using one word to describe what they were witnessing: capitulation. That means the selling isn't rational anymore. It's not orderly. It's pure panic. People dumping at any price just to get out, just to stop the pain and bleeding in their accounts. According to the data, this crash rivals some of the worst single-day declines in modern precious metals history. We have to go back to April 15th, 2013 to find something comparable. On that day, gold plummeted 9%, losing over $140. Silver crashed 11%. The trigger back then was news that Cyprus would sell gold reserves to pay for a bailout. But just like today, the real cause wasn't the news headline. The real cause was leverage. Too many speculators holding too many futures contracts with too much borrowed money. And here's the terrifying parallel. In 2013, precious metals had been in a bull market for over a decade. Gold had risen from $250 in 2000 to $1,900 in 2011. Silver had gone from $4 to $49. Everyone thought it would never end. But the April 15th crash was the beginning of a multi-year bear market. Gold didn't bottom until December 2015. Silver didn't bottom until that same month. From the peaks, gold fell 45%, silver fell 72%. Now, I'm not saying that's definitely going to happen this time. The fundamentals are different in many ways. Industrial demand for silver is much stronger now than it was back then. Supply deficits are real. But the pattern is eerily similar. Parabolic rally, extreme leverage, euphoria, and then one trigger, and the whole structure collapses. Let's talk about what this means for the US dollar, because this is crucial to understanding the bigger picture. The dollar is the inverse of precious metals. When the dollar goes up, precious metals typically go down. It's a mathematical relationship that's held true for decades. For the past year, silver and gold rallied primarily because the dollar was weakening. The dollar index officially broke below the key 97 level in January, reaching a low of 95.5. That's a 4-year low, the weakest the dollar has been since February of 2022. When the dollar weakens, it takes more dollars to buy the same ounce of silver, so prices rise. But on Friday, something shifted. The dollar gauge rose as much as 0.6%, making precious metals more expensive for most buyers around the world. That might not sound like much, but in a highly leveraged market where sentiment has already turned negative, 0.6% is enough to accelerate the cascade. The reason the dollar strengthened is directly tied to Kevin Warsh. His nomination represents a Fed that might actually defend the dollar's value. A Fed that might prioritize price stability over aggressive growth policies. And when traders realized that, they started buying dollars and selling precious metals. This dynamic is something that many retail investors, especially those newer to commodity trading, don't fully understand. Precious metals and the dollar are inversely correlated. When one goes up, the other typically goes down. When the market believes the Fed is going to defend the dollar, precious metals come under immediate pressure. It doesn't matter if the underlying fundamentals haven't changed. Sentiment trumps fundamentals in the short term every single time. Now, just hours after this crash, a headline started circulating that added fuel to the fire. Multiple financial news sources reported that a former chief strategist at JP Morgan is calling for silver to trade at roughly $50 later this year. Not 95, not 74, $50. He's essentially saying the rally from 70 to 121 was driven by speculation and meme trading, not fundamentals. And now that the speculation is unwinding, the price will collapse back to levels that actually reflect industrial demand. Let me be clear about something. This analyst no longer works at JP Morgan, so his views don't represent the bank's official position, but he's not some random person on the internet. He's one of the most respected analysts on Wall Street, and his warning is getting massive attention. He's comparing the current silver market to GameStop and AMC, saying it ends the same way with a catastrophic crash that wipes out everyone who bought near the top. So is he right? Will silver really go to 50? Let's look at the math. If silver is at 74 right now, a drop to 50 would be another 32% decline. That would represent a total collapse of 59% from the all-time high of 121. Is that possible? Absolutely. In 1980, silver dropped 80% from its peak. In 2011, it dropped 45% in a matter of weeks after hitting $49. So a 50% collapse from the peak is not unprecedented at all. But here's the counter-argument, and this is where it gets really interesting. Multiple analysts have pointed out that something strange is happening in this market. Several have used the word broken to describe the current price action. The head of strategy at one major firm pointed to unheard-of volatility and prices being driven less by physical supply and demand than by wild liquidity flows and algorithmic trading. Another analyst said the way silver is behaving is exaggerated and represents a series of disconnects from reality. So even the bulls and the bears agree on one fundamental thing. This market is not functioning normally right now. But they completely disagree on what comes next. Bears see a mania chart that's destined to crater all the way down to 50. Bulls see a genuine shortage with years of gains still ahead. Here's the paradox that's driving everyone absolutely insane. The fundamental case for higher silver prices hasn't actually changed at all. China's export controls are still firmly in place. Only 44 companies are licensed to export silver from China, and China processes 60 to 70% of the world's refined silver. That supply restriction is very real and ongoing. Industrial demand from solar panels hasn't gone anywhere. According to industry reports, roughly half of all new solar capacity added worldwide in 2024 was installed in China. Each solar panel requires about 20 grams of silver. That demand is accelerating, not slowing down. Data center demand from artificial intelligence infrastructure is real and growing. Microsoft, Amazon, Google, Meta are all spending hundreds of billions of dollars building AI data centers right now. Those data centers require silver for cooling systems and electrical infrastructure. That demand is only going to increase. The supply deficit is real. According to major banks, the structural deficit is expected to widen significantly this year. Global silver mine production in 2025 was approximately 850 million ounces. Total demand exceeded 1.2 billion ounces. That's a deficit of 350 million ounces per year. Exchange inventories have dropped 70% since 2020. In mid-January, over 33 million ounces were withdrawn for delivery in a single week. That's 26% of the total registered inventory gone in 7 days. So if the fundamentals are intact, if the supply deficit is real, if industrial demand is growing, why did silver crash 35%? The answer is leverage and sentiment. Markets are not rational in the short term. They're driven by fear and greed, by margin calls and forced liquidation, by technical levels and momentum. When sentiment shifts and fear takes over, fundamentals don't matter at all. Not in the moment. Not when everyone is trying to exit through the same door at the same time. So what should you do right now if you're holding silver or thinking about buying? Let me give you a practical framework. First, honestly assess your position. If you bought silver as a short-term trade, if you were using leverage, if you were chasing momentum because prices were going up, you made a mistake and the market just punished you severely for it. In that case, you need to cut your losses and move on. Do not try to make it back by doubling down. That's how traders go completely bankrupt. However, if you bought silver as a long-term hold, as a hedge against inflation and currency debasement, as a strategic allocation in a diversified portfolio, then nothing has fundamentally changed for your thesis. The supply deficit is still real. Industrial demand is still growing. Today's crash is noise, extremely painful noise that might test your conviction, but it's still just noise in the bigger picture. Second, do not panic sell at the bottom. The absolute worst time to sell anything is when everyone else is selling in a panic. That's when smart money buys. That's when fortunes are actually made. If you believe in the long-term thesis for silver, hold your position. And if you have cash on the sidelines, this could actually represent a buying opportunity, though you need to be prepared for more volatility. Third, watch the technical levels very carefully. As of Friday afternoon, silver was trading around $74 to $80 depending on the contract. The psychological $100 level is absolutely critical right now. If silver holds above 80 and starts to stabilize and rebound, that suggests the worst might be over. But if it breaks below 70 and tests 65 or 60, that suggests the cascade is continuing and that $50 target becomes much more realistic. Fourth, pay very close attention to the US dollar because the dollar is your key variable here. If the dollar continues to strengthen because Kevin Warsh signals a hawkish Fed, precious metals will remain under significant pressure. But if the dollar resumes its downtrend, if Trump overrules Warsh and demands aggressive rate cuts, precious metals will likely rebound strongly. Watch the dollar index like a hawk. It's your early warning system for what's coming next. Fifth, and this is absolutely critical, avoid leverage at all costs. Do not trade silver on margin. Do not use leveraged ETFs that promise 2 times or 3 times the daily returns. According to the reports, some leveraged silver funds lost over 60% in a single day. If you were using 3 times leverage, you got completely destroyed. If you want silver exposure, buy physical coins or bars and hold them in your own possession. Remove the counterparty risk entirely. Even after this brutal sell-off, both gold and silver posted substantial gains for January. Gold is still up around 9 to 13% for the month, depending on which contract you're looking at. Silver, despite yesterday's carnage, is still up double digits for January. These are not normal monthly returns under any circumstances. These are bubble returns, and bubbles don't deflate slowly and gracefully. They pop violently and without much warning. Let me share something with you that most mainstream financial media won't tell you. They're going to say silver crashed because of profit-taking. They're going to use vague phrases like market volatility and technical corrections. What they're not going to explain is the margin cascade. They're not going to connect the dots to the Warsh nomination. They're not going to show you the historical parallels to 1980 and 2013. They're not going to give you the full picture of what actually happened and why. I want to take a moment here to talk about something that's been weighing on my mind as I watched this unfold yesterday. There are real people behind these numbers we're discussing. People who are 50, 60, 70 years old, who worked their entire lives, saved diligently, and put a significant portion of their retirement savings into precious metals because they were told it was safe. They were told it was a store of value. They were told it would protect them from inflation and economic uncertainty. And now, in the span of a single trading day, they've watched 35% of their wealth evaporate. That's not just a number on a screen. That's someone's retirement dreams. That's someone's financial security. That's the difference between retiring comfortably and having to work additional years. This is why understanding markets and risk management is so critically important, especially as we get older and have less time to recover from catastrophic losses. The reality is that precious metals can be part of a sound investment strategy, but they need to be approached with clear eyes and realistic expectations. They're not a get-rich-quick scheme. They're not lottery tickets. And they certainly shouldn't represent your entire net worth or even a majority of your portfolio. Diversification isn't just some boring financial planning concept. It's the difference between weathering storms like this and getting completely wiped out. One thing that's particularly concerning about this crash is the role that social media and online forums played in fueling the mania. In the weeks leading up to Thursday's peak, platforms were absolutely flooded with people encouraging others to buy silver, predicting astronomical price targets, calling it the trade of the decade. There was this echo chamber effect where everyone was reinforcing everyone else's bullish conviction, and anyone who expressed caution or skepticism was dismissed or attacked. This is remarkably similar to what we saw with meme stocks a few years ago. The same patterns, the same psychology, the same tragic ending for people who bought at the top. The difference is that with silver, you're dealing with a commodity that has genuine industrial uses and a real supply-demand dynamic. But when speculation overwhelms those fundamentals, when prices detach from any reasonable valuation, the eventual correction is just as brutal as it was with purely speculative assets. I also want to address something that several of you might be wondering about. What about the people who were calling for silver to go to $200 or $300? Where are they now? Well, many of them have either gone silent or they're doubling down, claiming this is just a temporary shakeout engineered by big banks to steal shares from retail investors before the next leg up. You'll hear conspiracy theories about market manipulation, about paper silver versus physical silver, about how the real price should be much higher. Here's what I'll say about that. Are there manipulative forces in financial markets? Absolutely. Do large institutions have advantages that retail investors don't have? Without question. But when you're using conspiracy theories to explain away a 35% loss in a single day, you're not protecting yourself. You're rationalizing a mistake instead of learning from it. The market doesn't care about your theories or your predictions. The market simply is what it is, and right now, it's telling you that silver got way ahead of itself. That's exactly why channels like Element Axis exist. We cut through the noise and give you the real story with context and historical perspective. If you found this breakdown valuable, if you learned something that you didn't know before, I need you to share this video. Send it to your friends who invest in precious metals. Send it to family members who have retirement accounts. Send it to anyone who needs to understand what's really happening in these markets right now. And while you're at it, leave a comment below. Tell me what you think. Are you buying this dip or staying on the sidelines? Do you think we're headed to $50, or is this the final shakeout before the next major leg higher? I read every single comment, and your perspective matters because we're all trying to navigate these markets together. The crash from 121 to 74 is absolutely real. It happened yesterday, January 30th, 2026. It's the worst single-day crash in 13 years for silver and one of the worst in modern history. This might be the beginning of a much larger correction that takes us down to 50 or lower. Or this might be the final capitulation, the moment when all the weak hands got shaken out before the next explosive move higher. Nobody knows for certain which scenario will play out. The future is unknowable. But understanding what happened, understanding why it happened, understanding the forces at play and what to watch for next, that's your edge in these markets. That's what separates people who protect and grow their wealth from people who become casualties and statistics. History was made yesterday in the precious metals market. A historic rally that captivated investors for 9 straight months just experienced its first major catastrophe. The question now is simple. Will you learn from this event and position yourself accordingly? Or will you be another story of someone who got caught on the wrong side of one of the most violent market moves in modern history? Subscribe to Element Axis, drop a comment, and stay alert because this story is far from over.